Good morning. Welcome to subramani.com. Should you buy direct equity or should you invest through a mutual fund? The opinion on this is really divided. Many people feel that for the common investor it is better to go through the mutual fund, and in that even better to go through an index fund. So I hold that view for a very big portion of the population, maybe 95%, maybe 97%. But there are certain people who think that they can invest directly in equities. That is not wrong too. What are the advantages that you have? I was making an assumption that you are not a fund manager nor are you an employee in a mutual fund, because if you are an employee in a mutual fund, there are a lot of restrictions on what you can buy and what you can sell. But if you are on your own, you can be rolled into one as to very many things. For example, you can be a speculator, you can be a delivery based trader, you can be a value investor, you can be a deep value investor, everything enrolled into one. You need not put out a memorandum saying this is what I will do. Take my own example. I don't invest in real estate at all, because going by definition, real estate doesn't put cash in your hand, right? The yields are very low even if you give on rent. However, if your real estate portfolio doubles in 7 years, it means you've got 10% return. That's not too bad, right? So equity could be an investment avenue, real estate could be an investment avenue. Mutual funds is again largely debt or equities, right? The other assets don't really matter. I mean, of course there is gold, but sovereign gold bonds are perhaps better than the gold ETF. Now, why should you invest directly in equity? A, it means you know what you're doing. You're not dependent on a fund manager. After a fund manager's portfolio, you may like many things, you may not like many things, right? So you may not agree with him on certain shares, you may agree with him on certain shares. You really can't do, you cannot go and say, I want this. Like for example, a mutual fund is a ready-made shop, right? So you say collar size 40 and this is the length of the hand that you will get. And whereas if you go to a tailor, you can say collar size 40, I want shorter length, I want longer length, I want more circumference in the shirt. All those things you can change. So what are the advantages of going direct? First, don't buy too many shares, just buy one or two in a year. You got me right, one or two in a year. So over 30 years you build 40-50 shares, because you would have sold some, you would have replaced. Second, create a portfolio. While creating a portfolio, look at the index. I'm not saying buy all the shares of the index, buy the same industry. If 30% of the index is chemical, or 30% is finance, or 30% is automobile, have a look at it and make sure that your own portfolio is somewhere in that range. And if you are going completely out of the range, that is very solid reason why you are going out of the range in your long-term portfolio. In your short-term speculative portfolio, you can really do whatever you want. It doesn't really matter. Even the name of the company doesn't matter sometimes when you buy and sell. That's okay, provided you have very good help helping you in trading. My broker does all my trading. He just takes my consent once the deals are done. There are deals which he does without even asking me, which is perfectly fine. We share an extremely good relationship over the last 40 plus years. So then it works, otherwise it may not work for you, right? So read a lot before you buy one company. So if you want to buy one company in the automobile industry, you need to know about the automobile industry, you need to know about financing options, you need to know about auto ancillary, and you may end up buying any of those shares. You could buy an auto ancillary, you could buy a mainline auto, you could buy a Maruti saying this is the market leader, you could buy a Tata Motors saying they could rise up from the ashes, right? There could be other reasons, but you should know why you're buying it. Why are you buying a Tata Power? You should know, you should be able to write at least a 200 to 300 page 200 to 300 word article on why you're buying. There has to be logic in why you're buying. Build your portfolio, learn how to build your portfolio. There is nothing wrong in buying your own share, but there has to be a sense as to why you're buying, right? And unlike a fund manager, you don't have to stick to a particular style. You can be a speculator in one share, you can be a deep value investor in the other share. You can have a 30-year view on one share, right? You can have the full range of emotions packed into your portfolio. Don't try all this directly. First, create your own portfolio, imaginary portfolio, put it into some website and see how you're performing vis-a-vis some of the best fund managers. Right, but if you're doing a large cap fund, then make sure you're comparing yourself to a large cap fund. So create 2 portions or 3 portions, because there's no one single portfolio against which you can compare yourself. So create your large cap portfolio, your mid cap portfolio and small cap portfolio, whatever it is, say an imaginary amount of 50 lakhs per portfolio. So about 1.5 crores portfolio, how you would do it. Having created that, set the benchmarks. Decide that I will compare myself only to these 3-4 funds, right? Large cap, mid cap, whatever. Compare yourself only to those funds, because at every point in time, some fund would have performed better than you and some fund would have performed worse than you. Don't get worried about those things. But if you can pack all this, pack a lot of reading, balance sheets and understanding it and understanding the market circumstances, there is no reason why you should not invest in equities directly. There is a lot of excitement, there is learning, but however, after 6 months, 8 months, 1 year, if you are unable to beat the funds, that's fine. Give yourself 3 years. In 3 years, if you find that the outside portfolios, which means the good fund managers, are beating you by a huge margin, and you could not see the difference as to why they are able to initially, and then you found out what had happened, then stick to mutual funds. But don't stick only to mutual funds without trying equity. Try both. See what works for you. See what does not work for you. Based on that, you take a decision. There is no hurry to think that you cannot do this or you should do this. If you don't want to do any of these things, there is always an index fund, right? But if you think that you need help for an asset allocation, for risk profiling and choosing a fund, you have an advisor available. So all routes are available. You do directly into equity with the help of a good broker advisor. You get into mutual funds with the help of a good advisor. You get into mutual funds on your own, or maybe with the help of an advisor whom you pay a fee. Or you just don't do any of these things, saying I don't have time for any of this, I don't have the inclination to do this, therefore I'll stick to an index fund. Believe me, all 4 work. You have to see what works for you. I cannot say A will work or B will work. All work. I've seen various people in various buckets. Choose what works for you. Thank you.